In this section, we're going to go over some key accounting ratios. Ratios that can be useful in providing information as to the health of the company and things that may need improvement. And to do this, we'll look at some of these ratios. And we'll go to Analysis, Financial Manager, and you'll see here we have various percentages and ratios that can be used to help diagnose possible problems and causes for change. Now the first percentage you see is cost of sales as percentage of sales, and that's basically the cost of an item divided by its sales price. So for 1423, that would mean that if you sell an item for $100, that item cost $14.23. Now if you look at the next line, it's gross profit as percentage of sales. What this means is of that $100 item, $85.77 is profit before operating expenses. If you add these two together, you will get the 100. Now the next line item is net income as percentage of sales. Now this is basically gross profit minus all the operating expenses, say wages, advertising, rent, insurance. And what this will say is basically of that $100 item you sold, you will keep $53.82 as profit. Beautiful. Wonderful. Highly unlikely, but let's just dwell on the nice things for now. That means for every $100 item, you will take away $53.82 in profit. That is a good place to be in. Now the next items are percentage in terms of profitability. And the first line item here is return on total assets as percentage. Now this ratio is basically your net income, which is your sales minus cost of goods sold minus your operating expenses, is divided by the total assets, which would include your current assets and long-term assets. So you'd have your net income divided by your total assets, and that for this company would equal 14.69%, which means for every $100 in assets you have on the books, you are generating $14.69 in income. In the next line, we have return on net worth. Now here you have the net income divided by your net worth. Your net worth is your assets less your liabilities. So what this is saying is that for your net worth, which is your asset less your liabilities, for every $100 in this net worth, you are generating $21.29 for every $100. Beautiful. Now here we have a list of your current assets, current liabilities, and your current ratio. Your current ratio is basically your current assets divided by your current liabilities. Basically this shows your ability to meet creditors' demands. For most companies, 2 is acceptable. But again, all ratios have to be compared with the business you're in. Each business has different ratios and percentages. The idea is to measure your current ratio and compare it to the current ratio of those businesses that are in the same field as you are. In the next section, we have working capital and we have inventory turnover. Now, inventory turnover basically means how many times a company's inventory is sold and replaced over a certain period. There's several ways to record this. You can record it by sales divided by inventory, or cost of goods sold divided by average inventory. Now, most accountants would use the cost of goods sold by average inventory because the sales divided by inventory would not be as accurate because the sales has a profit element added to it. So let's go over an example using the cost of goods sold divided by the average inventory. Let's just say during a certain period that we have $10,000 of average finished products in inventory during the month. Well, let's just say that for a certain period the cost of goods sold was $10,000 and that the average finished products inventory during this period is $1,000. This would give us a turnover rate of 10. And this would mean that we would be able to sell out our inventory 10 times during this particular period. This ratio as well should be compared against industry averages. The general consensus is that the higher your inventory rate, the better, because you do not want to be left with inventory. You know, it's the market, it's the free market, hopefully, and you do not want to get stuck with inventory. There are price changes, it leaves more risk. Better to get it in and out as fast as possible. Now the next line item is days AR outstanding, and for this company we have 15.39 days, which is reasonable. I've been dealing with AR for over 16 years, and you have some clients that pay you rather quickly, and you have some clients that'll pay you 60 days. They're very consistent in their lack of paying on time. So again, of course, it's best to have a lower number. You want that money fast, you could use it. So the lower the better. One of the other ratios you will probably come across, and is kind of a replacement for the current ratio, is the quick ratio. And this is basically cash plus cash equivalents plus marketable securities plus AR divided by current liabilities. And people believe this is more of an accurate way to discover or find out the ability to meet the demands of creditors in paying your bills. So the quick ratio is cash, cash equivalents, marketable securities plus AR divided by current liabilities. And it's generally accepted that 1 and higher is acceptable. So these are some of the key ratios and percentages that you'll find in your career, and there's something that you could be looked at each month and compared to other months and see the trajectory. You of Of course, you want to improve on everything. You want to improve on yourself. You want to improve on your business. And these are ratios you could look at and observe and try to improve upon.